you can't go putting that into a trust and live there and think that you've done something to save inheritance tax.
Perhaps the misconception is that trusts are these magic solution to avoid all sorts of tax.
Waste the money and fritter money. It is about control then, isn't it?
That harsh taxation regime we touched upon with the 10-year anniversary and those sort of things doesn't apply to a vulnerable person's trust.
Am I right in saying that 300,000 put into a trust would not attract an entry tax? Hello, thank you for joining me today. We're going to be talking about trusts. Trusts seem to be spoken about quite a bit now, subsequent to the budget, where people are trying to think of ways that they may be able to plan a little differently to mitigate the effects of possibly increased inheritance tax. I'm joined today by my colleague Pippa Bavington, who is an absolute expert on trusts. I would definitely go to her, and I am today, for all the answers to all the questions that are raised, because they're quite complicated, aren't they? Are we honest if we say that?
Yes, absolutely. And I think that's the danger, is that a lot of people think, oh, well, I like this idea, I will go for it, without really understanding what it involves or if it's suitable for you. Because just because your neighbour Bob did it doesn't mean it's good for you. So it's like so many things, it's a very legal answer, but it depends.
Yes. I think, what is the impression of people that come to you saying, I'd like to put something in a trust? What do you think is the basic understanding of a trust? And is that different than the reality?
Well, actually, there seems to be quite a broad spectrum. There's those clients who are quite familiar with what a trust, at least conceptually, does, in terms of it's a legal mechanism that can hold an asset, similar to a limited company.
Yes.
And then you have other people that are very frank. They say, I read about it, or so-and-so told me about it, and I thought I'd better find out, which actually is almost ideal, isn't it, when someone comes to you really open and just say, I know I don't know enough, but I feel like it's something I need to explore.
I mean, we've always said for many years, haven't we, that trusts are a great form of controlling how an asset is looked after or spent, but not necessarily great for tax. Is that a fair summary?
And I don't think the budget has affected that per se. I mean, there is perhaps the misconception is that trusts are these magic solution to avoid all sorts of tax and all sorts of other pitfalls. But actually, they're complex, which comes with its own burdens, shall we say. And I think it's just being really frank and having open discussions about, okay, what is your priority? Because like you say, control is a big factor and a very useful way in which we can use trust.
Yes.
I mean, we're using the umbrella term here, trust, but of course there's so many different types as well.
So if you are a grandparent and you want to leave a large amount of money or an asset to very young children, a trust is the only way sensibly to do that.
Yes, I mean, that's a very basic type of trust, and those arise very easily and almost by accident sometimes, because if you say, well, I want to give so-and-so £5,000 when they reach 18 and unfortunately you die before they're 18, say, then that's held in a bare trust, which, literally just that age contingency, nothing more to it. But just because the trust is simple doesn't mean that the management of it is. And it might still need registration with HMRC, for example, and you've still got trustees that have duties that they need to be aware of.
And there's still potentially tax to be paid within the trust. And I think that's something that is a difficult concept.
I think it's difficult because, as I mentioned before, it's a separate legal being, if you like, a trust. And people say, oh, it's all right, I'm sure this trust doesn't have any tax to pay, because I've heard trusts are wonderful things. Quite the opposite, actually, because most trusts, if they're set up during your lifetime compared to a trust you might put in your will, is really subject to quite a harsh taxation regime.
Yes.
And it's that people are not aware of, I think, or unfortunately sometimes haven't received the best advice, maybe.
No. So I began by mentioning inheritance tax, but the tax we're talking about within a trust is actually income tax or even capital gains tax.
Both of those, but also inheritance tax in some situations. Different type of inheritance tax, believe it or not. So many ways that HMRC can tax you. And some trusts created during your lifetime, you would pay tax when you set up that trust. Inheritance tax, I should say. And which seems really counterintuitive because, of course, usually we think, well, inheritance tax, something I pay or my estate pays when I die. But it might be something you pay during your lifetime, or that the trust pays during your lifetime.
So is that basically if you're putting too much into a trust in one go?
Yes.
Yes.
Yeah.
And then these anniversary taxes, what are those? Could you explain?
Those are types of inheritance tax, really. They're this taxation regime that applies to quite a lot, or majority of lifetime trusts. So every 10 years there could be this anniversary charge. The entry charge is what I've just mentioned.
Oh, yes.
So inheritance tax when you put assets into the trust, and also an exit charge.
Yes.
So in some cases, if then any funds are paid out of the trust, and those are done on a percentage basis usually, and it depends on whether it's within the first 10 years of the trust or not as well. And that's where it gets really messy potentially, particularly if someone has been quite innocently running a trust that perhaps a grandparent or great-grandparent set up, didn't quite realise the nature of that trust and actually everything that ought to have been done with that.
So that's quite a big responsibility for a trustee, isn't it? So if you're asked to be a trustee, be careful.
Hugely, yes. And I think an executor role can be complex, but more often than not, it's not. It's I administer an estate, then I'm done. A trustee role tends to be ongoing.
Yes.
And actually have in some ways a lot more to it. I guess because it's more nuanced.
Yes.
And because it can literally be a daily role.
Yeah. So in terms of, if I'm sitting here thinking, oh, damn, I'm now going to be caught by inheritance tax because of various factors. Oh, I think I'll set up a trust and that will get rid of 300,000, let's say. Am I right in saying that 300,000 put into a trust would not attract an entry tax?
Depends, of course. Again, that lawyer answer. It depends on whether you've made previous gifts prior to setting up that trust. Yeah. But in theory, that is below the threshold as we know it. Yes.
Another word we love, potentially.
Potentially, maybe.
Yes, depends on your circumstances. But potentially you could set up a trust for 300,000 thinking, well, that will reduce the amount that I leave when I die by 300,000. But then there's all the other considerations that you mentioned. And it's really important, I guess, to work out financially whether the tax is going to be worth it.
Yeah, and there's a lovely expression that I love is, do you want to let the tax tail wag the dog? Do you actually want to get rid of £300,000 worth of asset in that case? And why are you doing it?
Yes.
I would argue hedonism is a much better tax-saving tool. But, if we're talking about a lot of surplus wealth, then a trust is useful. Or if we're talking about protecting a vulnerable beneficiary, which is a different type of trust that is valuable.
It's worth touching on, though. Yep. So we mentioned the children, if you've got young children, but again, you could have other vulnerable beneficiaries, somebody who couldn't manage the money themselves, perhaps is entitled to welfare benefits, or you're concerned they may waste the money and fritter money. It is about control then, isn't it?
It is, and it's protecting someone from themselves sometimes, or quite often from third parties. Yes. So obviously we manage a lot of vulnerable or disabled people's trusts. Those terms are used interchangeably by HMRC, and there are set criteria for that type of trust.
And tax break, less tax, isn't there?
Yeah, they don't, that harsh taxation regime we touched upon with the 10-year anniversary and those sort of things doesn't apply to a vulnerable person's trust. But they are strict, they're narrower because they're defined for a specific purpose. They work incredibly well in practice.
They do. Yeah. They do. I think, as speaking as somebody who obviously my area is the vulnerable person piece and disabled adults who are unable to manage monies for themselves, the trust works so well in terms of two sensible trustees ensuring the best interests of that individual and that they have what they want without their other things being affected. But in actual fact, there's also this more advantageous tax regime to that. So another reason why people wanting to benefit loved ones with that vulnerability, they could actually, they could set those up in their lifetime, couldn't they?
Yes, and I've created lifetime trust for clients in that fortunate position that they have got that extra money and they want to buy a house for a daughter that's got various diagnoses, mental, physical, whatever it might be, or is in an exploitive relationship and they want to protect it.
That's very true.
Yeah, but it is making sure that the criteria satisfies, because otherwise what you might do is set up a trust not realising the type of trust that you've actually entered into.
Yes. And once a lifetime trust has been set up in that way, can other money being added to it and by different people?
Yes. So the person that set it up is called the settler. They're setting up the trust, but other people can contribute to it. And that's one of the advantages, of course. Let's take a few generations.
Yes.
Say mum and dad set up a vulnerable person's trust for an adult child that has, severe disabilities, mental or physical. Within their wills, they don't need to set up a trust again. It's there, ready to go. Other relatives, grandparents can reference it in their own wills or make lifetime contributions to it. So holistic planning like that is really valuable.
It is, and it's also about spreading the word, that because we've seen it so many times, so sadly, that a grandparent wants to make a nice gift to one of their grandchildren that's got more special needs than another, and it gets caught by the fact they haven't put it into a trust. Whereas if there's a trust vehicle set up, it can all go into the same place.
Yeah, I think we have a call at least a couple of times a week, don't we? Someone saying, I've inherited, but actually I can't inherit because it's really going to be to my detriment. And after the event, there's usually nothing you can do about it. No. It's all about planning.
Yes.
So much is.
Yes. And then if we move on to discretionary trusts, which are quite common these days, I think, but perhaps not so common as they were before the nil rate band could be transferred. Yeah. But again, let's use myself as an example. I decide I want to put some money into a trust to remove it from my estate, but I kind of want to be able to use it a bit.
Yeah. Well,
I know that's cheeky and you're not really supposed to do that, but does a discretionary trust work for that?
Again, it depends on what your aim is. If it's for inheritance tax purposes, then generally no, because if you're retaining a benefit, you're not really giving that asset away, and HMRC will see through that arrangement. There are some situations where some benefit might be permissible, but it's rare, and HMRC are likely to look into it and say, well, you've given it away to this trust, why you maintain it? So let's say it's a rental property, and you place the property into the trust, but you retain the income. Yeah, you're a beneficiary of the trust. Which is fine, absolutely nothing wrong with that. But for inheritance tax purposes, you're still retaining a benefit.
Yes.
It's still useful for estate planning, as in succession planning or control. It won't help you generally from a tax perspective.
What about if you bought a holiday home and put it into a discretionary trust? How does that work? Could I go on holiday there?
If you pay for your stay there, yes.
Okay.
But otherwise, generally, the same applies. Same with a work of art. If you give away a work of art to a relative, rather than into a trust, say, but as an outright gift, if you borrow it for a few weeks a year as well, you're still retaining some of that that item's value.
So it needs to be you need to properly separate yourself from the asset that you've given away. And any time you come in contact with it, if you like, you'll need to be paying market value for it to show, and that all needs to be documented, doesn't it?
Yeah. Because without the documentation, your executors are going to be facing an uphill battle at that point.
Yes. So these are really tricky areas, aren't they?
Absolutely.
So, just in the past month, we've all seen increased inquiries about how can I do this? How can I do that? Can I put my pension into a trust? Well, pensions, we're saying careful at the moment, whatever you do. Yes. Would you agree?
Absolutely. I mean, the pension changes are not, obviously we've had the budget, but the details haven't been worked out yet. And some of the concepts about how pensions will be taxed with inheritance tax in future, and the overlap with an estate administration and how that's going to work, bit of a minefield potentially. But until we actually know all the details, we can't It was the same when they introduced the residence nil rate band. You sort
Yeah.
of knew something was going to happen. You knew it was going to be complex. But actually, it wasn't until it was in practice that you actually noticed how it would play out.
But am I right in summing up that the actual taxation and rules around tax trusts were not changed by the budget?
No, generally not. There were some changes, of course, so capital gains tax limits
Yes.
will have affected trustees
Yes.
as well, but there was nothing specifically targeted at trusts per se.
Fine. So in terms of your usual making of trusts, particularly vulnerable adults,
Yep.
ones, as it was, and always good to really talk it through, the appointment of trustees, particularly the number of trustees, the drivers behind the trust are crucial, aren't they? But in terms of using it for tax planning, nothing very much has changed, except that probably people are going to be looking at it a bit more, and it's worth looking at, would you say?
It's worth looking at, yes,
Yeah.
but I wouldn't have it sort of, I wouldn't put too much weight on what it can do for you for tax saving purposes.
Yeah.
Usually if there are other reasons to set up a trust, and this is where the Vulnerable Persons Trust does have a double benefit, if you like, but it generally shouldn't be a driver, I would say.
No.
It is more about succession planning quite carefully, and if inheritance tax can be a positive part of that, inheritance tax saving, I should say, then great. But I wouldn't, place all your expectations on
No.
a trust will save all your tax problems.
But of course, and one of the biggest issues for people is normally their most valuable asset is their home.
Yeah.
And, you can't go putting that into a trust and live there and think that you've done something to save inheritance tax.
I mean, sadly, we see it.
We do.
We
Yes.
see where unregulated, I'm not even sure I can use the word professionals, unregulated people are advising people to put asset protection trust, which isn't even a legal definition,
no.
but it seems to have become it in some circles, saying, you can put your property into a trust and then you'll be saved from everything.
Yeah.
That's just not how it
It's
works.
a big no-no, yes.
It's really upsetting when you see people who have they've taken advice, just unfortunately, from someone that isn't regulated.
Yes. But in an ideal world, if you've got assets and you want to try and work out the best way that you can leave as much of it as you can, either for the beneficiaries that you want to protect or to make the most of the tax regime, get advice, but also potentially include your accountant or IFA with someone such as yourself and talk it all through, because we all have a different perspective, don't we? It's about the numbers, but it's about the people and about what you want to achieve for them all.
And I think a good financial advice and accountant sort of, I've had roundtable conferences with clients to this effect, and it can feel a bit overwhelming for the client, understandably, so many professionals involved, but actually they've come away really informed and being able to make decisions, not always easy decisions, but clarity is something it's given them. But it takes a lot to say, actually, I am going to front this now. I'm not going to put my head in the sand. I'm going to get all the advice that I need and just get it done. Yeah.
Oh, Pippa, thank you so much. You've clarified a lot, raised a lot of questions as ever as well, but it's a starting point. Thank you for being here.
Been a pleasure.